Welcome to Your Money Guides, brought to you by Interface Financial Planning. In this guide, I'm going to look at behavioural finance. Behavioural finance studies the psychology of financial decisions and is especially important in the investment arena. It explains how investors can sometimes act irrationally or from an emotive viewpoint, with ingrained and unhelpful biases in their approach. If investors understand these better, it is likely they will make better decisions, avoid painful financial errors, and reduce their propensity to suffer losses. Learning about behavioural finance is an important step for investors, even for experienced investors. The most relevant area for investors starts with an appreciation of how biases can often play a big part in investment decisions. These biases are often hardwired within us, with valuable benefits in our everyday life. However, when it comes to money matters, they can have the opposite effect. Understanding and spotting these biases when they arise can make a positive difference to outcomes. Behavioural finance is an incredibly rich and detailed subject. In this short guide, I will cover a couple of the key points. One is to give you a feel for the subject and to produce examples where it fits into the investment process. It's not intended to provide an in-depth analysis. The second is to show how an understanding of behavioural finance connects to traditional finance theories, and from there, how this can influence the decisions taken towards an effective financial planning approach. In some cases, the examples that follow will overlap, so that some of the behavioural characteristics described will encompass more than one bias or trait that may exist. Perhaps the most common trait amongst investors is their emotional connection with incurring losses. Significant research has been done around this factor. There are two main aspects to focus on. The first is the fear of losses, and the second is the behaviour in the reaction to losses once occurred. The fear of loss can lead investors to choose the wrong investments for their situations, or pursue an inappropriate strategy. People are known to apply more emotional weight to losses than to gains. In other words, the pain of loss is considered greater than the pleasure of a profit. In some cases, this mismatch can be significant, and it can produce an aversion towards otherwise appropriate options, as the loss-fearing investor chooses investments which have the wrong risk-reward levels to meet their needs. In terms of how investors can behave when losses are incurred, there are strange and irrational traits which can often appear. A good example is when an investor waits for an investment to return to its original purchase price or value. For example, an investment is purchased for £10,000, but after a few years has fallen in value to £8,700. The investor decides to hang on to the investment until it gets back to £10,000 and then sell it. This is irrational, as there is no connection to the question of whether the investment remains the best place for that £8,700 at that time. Does the investment still fit with the wider strategy? Is there a reason it has fallen, or is it simply normal market volatility? Are there better options now available for the money, and so on? The historic purchase price has limited or zero relevance to the current position or prospects. It makes no sense to attach any importance to that figure. There's further evidence that investors do not like or feel comfortable with locking in losses. It's as if the paper loss at any given moment is unreal, whereas the actual loss, should the sell order proceed, is real. Yet the fact is the loss has already occurred, regardless of whether it's locked in. Deciding to hold on to the investment simply to avoid formalising the loss makes no sense. Investors' behaviour can be irrational in this respect. Let's now take a look at confirmation biases. These show up in human behaviour on a regular basis. The basic thrust is that we tend to look for information that reinforces our already held beliefs. This can be particularly relevant when considering opinions such as political views. It can be both positive and negative in nature, which means we can search out and spend time looking for material, views and articles which reconfirm our beliefs, but also avoid anything which may challenge or correct our beliefs. In finance and investment terms, confirmation bias is very important. We may believe something to be true and base decisions on that truth without ever taking the time to study the substance or evidence behind it. An example of this would be when an individual is wedded to property investment believing that you can't go wrong with bricks and mortar. They would lean towards reading or hearing anything positive about such investment approaches, which is the affirmation of their view, ignoring the evidence that this is far from the case. The reality is that property investing is inherently risky and over time is subject to market fluctuations. Some studies show that in longer-term equity investing such as company shares outperform property investments. Investing in property will often form part of a comprehensive and diversified portfolio, but staking too much in this area could be problematic. A failure to evaluate the entire position and to overweigh some information or evidence in favour of other information can easily lead to poor decisions and outcomes. Studies also show that individuals tend to act with overconfidence in a wide range of areas, believing their abilities are greater than they are. A good example would be in forecasting future investment outcomes, or picking a winning investment such as a share or a fund. This is something individual investors should be wary about. But the good news is that this is not restricted to amateurs, with studies also showing that this trait is rife amongst professionals as well. An example of this is in a study of professional fund managers, which showed that 74% of those managers considered their skills above average. 26% considered themselves average, while none considered themselves below average. This area is made more complex by the inclusion of luck. For example, a confident investor may make an investment decision such as betting on a big rise in shares in the near future. They stake their money accordingly, and a big rise in shares takes place. This outcome is great for that investor, who then assumes a position where they were correct in their analysis, which led to their decision. This investor may have been right simply due to chance. They are no more or less qualified than after their success than they were before it to make successful predictions, yet their confidence will tend towards a belief that they are more qualified. Likewise, studies and research show that when investors have a success, they will usually put this down to their skill, but when they suffer a setback, this will be down to bad luck. Overconfidence can lead to taking the wrong position in certain investments. A mistaken belief that the investor can time the market and more often a tendency to trade too much is an aspect known as overtrading. All of these have been proven to be exceptionally detrimental in the long run in terms of investment returns. Take emotions out of the equation, and conventional finance theories show that investors who succeed over periods of time are the ones who follow a strategy of diversification, which has at its centre an understanding that investments, markets, and indeed economic conditions are largely unpredictable. The key is to pursue a diversified portfolio approach, one that has a respect for the unpredictable position investors face. We should also consider herding. Herding is relevant when decisions are taken based on the safety net of the crowd, i.e., because everybody else is following a certain pathway, that must be the best pathway to follow. This shows up time and time again in markets. Examples appear in economic history all the time, notably with the tech stocks in the late 1990s, when investors piled into technology company shares simply on the basis that that was what everybody else was doing. The fundamentals of whether this was a good place for one's money were thrown out of the window. This particular example is loosely related to a bias known as regret, the idea that if you don't do something, you may regret it. In the case of the technology shares, the regret would be that a co-worker, family member or friend did invest making big gains, whilst you missed out. Having the ability to correctly identify the information that matters and the information that doesn't is also an important factor, and one that behavioural psychologists have studied in depth. Biases appear in respect of information on a regular basis. For example, there is a bias known as anchoring. This is where an individual anchors their view or decision on some form of information that has limited relevance. In investment terms, a good example would be a stock market index number. Big round numbers tend to have more meaning in people's minds. When the Dow Jones Index hits 20,000 or 25,000, this can have an impact, yet it really has no meaning as opposed to any other number. Yet we can anchor around this number as it gives us something tangible. The same is true of market crashes. Research shows the more recent a market crash occurred, the more it plays in the minds of investors. The irony in this example is that the crash should, in theory, make investing more palatable, and not less so. This is because prices are lower, yet the anchoring effect can make investors more fearful and less likely to invest. This is all down to how recent the last serious market downturn was. This is sometimes known as availability bias, where the most recent information or news is given more prominence. Each of these categories are some of the various biases that commonly exist in the investment world and can adversely influence investors' decisions. This can lead to suboptimal outcomes. There are other biases which make up the subject, and investors can gain a significant advantage by learning more about all of these. Also, working with a professional advisor who understands how they fit into the process will also be advantageous. So, how can you use an understanding of behavioural finance to your advantage? Conventional theories, such as the capital asset pricing model or CAPM, or the efficient market hypothesis, EMH, are built on firm foundations. However, there are flaws. This is because the theories generally work on a basis that people will act rationally. Yet over time, this has shown not to be the case. It is when people, or in this case investors, act irrationally that mistakes happen. Unnecessary losses are incurred, or the individual ends up with suboptimal outcomes. In investment terms, these comprehensive theories encourage the use of a diversified portfolio approach aligned to the individual's risk profile. If investors can recognise the behavioural finance applications, then the two theories can be combined. This understanding of behavioural finance can help with a number of things. Firstly, determining the investment strategy and plan of action. It can also give a reference point to the decision-making process and how to take decisions, and also provide support to those decisions, both long and short term. It can also help with how to invest in relation to one's goals, and also deciding when and how to rebalance a portfolio. There can also be a checkpoint when things don't go according to plan. This understanding of behavioural finance will give you a more robust financial approach. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.